Hi all, welcome to Indian economy session. So today we are going to deal with money and banking. See, when you analyze the previous year question papers of UPSC prelims, you will get an idea that money and banking is the most important topic in Indian economy for the UPSC prelims. So before we move on to the topic, I want to tell you a few things. See, for most of the students, Indian economy is considered as a tough subject. But I can tell you, it is not. It is one of the easiest subject for prelims. You know why? Because the syllabus is very small. See, when you compare with other subjects, the syllabus of Indian economy is very small. But before you start preparation, you need to keep two things in mind. The first one is, when you study something from Indian economy, you need to have a good clarity on that topic. That means you should clearly understand the concept or the basic definition of what you study. So clarity is essential. Then the next thing is, you must need newspaper daily. See, reading newspaper is essential because the subject is not in economics. The subject is Indian economy. So they can ask questions from agriculture or banking or taxation or budget or survey, anything. So if you are not reading the question paper, you may not get a good idea about what is happening around you. So when the question comes for the UPSC prelims, you will get confused. So daily reading newspaper is another essential thing. So there are two things. First of all, you need to get a good clarity on what you study. Then read newspaper daily. That means I do not suggest you to go very much deeper into the news. At least you need to know what is happening around you. At least you need to go through the headlines. Okay. So now we can move on to our topic, that is money and banking, the most important topic. See, if you analyze the previous year question papers, you can see that over the last 10 years, more than 60 questions were asked from this topic alone. So that shows on an average 6 questions are asked per year. So 6 questions for UPSC prelims out of 100. On an average, 6 questions are asked from money and banking topic. So as I said, we need to start from the basics. So what is the definition of money? So what is money? That is the first thing we need to know. See, when I say money, the first thing that comes to your mind will be currency notes and coins. So take that point and try to make a definition. What is money? Money is nothing but anything that can be exchanged for goods and services. So anything that can be exchanged for goods and services is termed as money. So when you start a topic, you need to start from the basic. So get a good grip on the basics. So money is anything that can be exchanged for a good or services. So as I told you, the first thing that comes to our mind when I tell the word money will be currency notes and coins. So before the issuance of currency notes and coins, we used to have a system called barter system. As you all know, that will be exchanging one commodity for another commodity or service, right? See, I'll be exchanging my commodity with another commodity. So that is barter system, but that system has some deficiencies. So we need to study what are the deficiencies of that barter system and how the new age currency notes and coins have rectified those deficiencies. So what are the issues with barter system? First one is, you can take a look, lack of common measure of value. Lack of common measure of value. Suppose I have a goat with me and I am in need of rice. So somebody else from my area will be having rice with them. The only thing that I can exchange for that rice will be a goat. A goat. Okay. So how can I compare the value of my goat with that of the rice? That is the first issue. Lack of common measure of value. I cannot compare my goat with that of the rice. Okay. So next thing is lack of double coincidence of demand. Lack of double coincidence of demand. So that means I should have a demand and the person with whom I exchanged the commodity should also have a demand. Let me come to the previous example. Suppose I am having a goat and he is having some rice with him. I can only exchange my goat with that rice owner only if he needs the goat, right? I am having a demand for rice. I need rice. So the demand for rice is there. I can get the rice only if he needs my goat. If he needs something else, he will not exchange his rice with me. So that is lack of double coincidence of demand. So the demand should coincide. The demands of both parties who are engaged in the barter system should coincide. Only then that exchange will take place. Okay. Indivisibility of commodity is the third issue. Indivisibility of the commodity. So what do you mean by this? Indivisibility. Suppose he is having 2 kilogram of rice and I am having a full whole goat. So as per the local comparison, we come to the conclusion that the 2 kilogram of rice is equivalent to half part of my goat. So how can I transact with him? I cannot cut my goat and give half part to him, right? So that is indivisibility of commodities. If the commodities cannot be divided, how can that transaction be properly conducted? So that is another issue with barter system. Next one is obviously the storing of wealth. So how can we store this wealth? He is having a rice. He cannot store it for an entire year, right? It will get rotten. So his wealth is rice. So he cannot store it for a longer period of time as it will get rotten. So the storing of wealth is another issue. When it comes to our current coin or currency note, we can store it easily, right? So another issue is with storing of wealth. Then the next one is difficulty in making deferred payments. See, deferred payments is one of the best thing that we can do with our currency notes, right? So see, I can say to that person that I'll give you my money on that X date. So I'll give you the money next month, or I'll give you the money after 6 months. Right now I can say I'll give you your money after 6 months. But in case of commodities during the barter systems age, how can you say that? Suppose I am saying to that man, "Arey yaar, give me the rice right now. I'll give you my goat after 6 months." Okay, I can say this. I can defer my payment after 6 months. But what will happen if the goat dies before that? See, if the goat dies tomorrow, how can I make that payment? I have made a deferred payment by saying to him that you give me the rice right now, I'll give you the goat after 6 months. If he agree, then the transaction will take place. But what if the goat dies next day? How can I make my payment? So this is another issue, the issue with deferred payment. The next one is promo storage, obviously. Okay, so these are the issues with barter system. So there comes our hero, the new age money, right? So what are the different types of money? See, money can be classified into common money and bank money. Common money can again be classified into coins and currency notes, while the bank money can be divided into checks and drafts. So let this part be, we can set this part aside. Come to this part, our common money. Common money can be classified into coins and currency notes, and coins are again divided into full bodied money and token money. So coins are classified into full bodied and token money. So what is the difference between full bodied money and token money? The difference lies in the commodity value and the face value of the money. Difference lies in the commodity value and money value. For full bodied money, the money value will be equal to, money value is equal to commodity value. For full bodied money, the money value will be equal to the commodity value. For example, suppose you will be making a copper coin, and copper coin of 10 rupees. So if it is a full bodied money, then the coin's weight will be equal to the value of the money. So, that means for a 10 rupee coin, the money value will be 10 rupee and the copper will be of value 10 rupee. So the commodity value that is used for making the coin will be as same as the money value of the coin. A 10 rupee copper coin is equal to the copper worth 10 rupees. Okay, so that is full bodied money. In case of token money, it is different. There the money value will be greater than the commodity value. So money value will be greater than the commodity value. That is what we are using right now. Right now a 10 rupee coin, the money value will be 10 rupee. But the actual commodity that is used to create the coin will be less than 10 rupees. So money value will be greater than commodity value in case of token money, and money value will be equal to the commodity value in case of full bodied money. Now in case of currencies, we can divide it. Currency notes can be divided into representative paper notes and fiat money. Fiat money is one of the important term. It is fiat money. Fiat money is one of the important term that appears during our preparation and also in the UPSC prelims. So what is fiat money? If you are reading newspaper, the term usually comes across you and it says that ours is a fiat money. So fiat money is nothing else. It is a legal tender backed by the government. Legal tender backed by the government. So it's a legal tender backed by the government. That means it is not backed by any commodity. The backing for the money is given by the government. If you look at your 10 rupee currency note or 100 rupee or 500 rupee currency note, there is a promise, right? There is a promise by the Reserve Bank governor that I promise to pay the bearer a sum of 500 rupees. Okay, I promise to pay the bearer a sum of 500 rupees. So the Reserve Bank governor is giving the promise upon the backing of the government. So the government is backing. The government is supporting that issue. The government is supporting the issue of that currency. So fiat money is a legal tender backed by the government and not by any commodity. It is not backed by gold. It is not backed by silver or any commodity. It is backed by the government. The government is supporting. The government is assuring you that, okay, this money is legal tender. This money is valid. We promise to pay the bearer this sum. Okay, that is legal money. And when it comes, and it does not have an intrinsic value. See, the paper itself does not have an intrinsic value. It's just a piece of paper with some writings and some designs. But the real value to that paper will be given by the government, by the RBI. So that is fiat money. And this one is representative paper notes. What is that? Representative paper notes are money backed by a commodity. I've already told you fiat money is backed by the government, while representative paper notes are backed by the commodity. Suppose 10 kilos of gold are there. So that gold will be the backing for representative paper note. A commodity, usually gold, will be used to back an issuance of a rupee. Okay, so if a commodity is used to back the money, then it is representative paper notes. If the government is backing the issuance of that money, then it will be considered a fiat money. So these are the different types of common money. Now we can move on to bank money. See, these are two familiar terms, checks and demand draft. Checks and demand draft are the two common terms that we come across. So what is the difference between check and draft? See, it is similar to this representative money and fiat money, the backing. That is the main difference between check and draft. So in the case of check, the backing is given by the individual. Suppose I am writing a check in the name of X. I am backing the check. So while issuing the check, it is not necessary that the amount is there in my account. It is not necessary that the amount is there in my account, but still I can write the check. But in the case of draft or demand draft, the backing is given by the bank, because I need to prepay the amount to the bank, and only after I pay the bank, they will issue the demand draft. So basic difference is this. First one, check is it's like a backing. It's backed by an individual, or it is supported by an individual, and demand draft is it will be backed by the government upon payment from that individual. So these are the different types of money. After studying money, we need to study about the type of bank deposits. So these are the common type of bank deposits that we need to study. The first one is demand deposit. The name itself suggests that it is demand. Who demands? Whenever I demand my money, bank should give me. That is demand deposit. Okay, we all will be having a savings bank account in our bank, right? That is a form of demand deposit. See, we can deposit money anytime and we can withdraw the money anytime. So whenever I ask for money, they cannot say no. Whenever I ask for money, they should give it to me. So whenever I demand, they should give it to me. So such kind of accounts are known as demand deposit, and it can be withdrawn at any time. Then comes our time deposits, and the most familiar one is fixed deposit. See, FDs are a depositor for a particular period of time, right? For 6 months or for 1 year, 2 year, 1.5 year, 5 year, like for a longer term. So you can withdraw the amount only after the expiry of that term in case of time deposits. So time deposits are for a particular period of time. Fixed deposit, recurrent deposits are examples of that kind of deposits. Then there are some other deposits we need to study. Usually deposits with RBI. These are deposits with the RBI that are deposited by government, other public financial institutions, etc. So these are the three main kind of deposits. So we need to know two more things. What is total bank deposit? Means a total of all these three. Total bank deposit means it's the demand deposit plus time deposit plus other deposits. And another term is net bank deposit. Net bank deposit includes only demand deposit and time deposits. Net bank deposit consists of only demand deposit and time deposit, and it excludes the other deposits. Okay, so now we have an idea about what money is, what the different kinds of deposits are. Now the one of the most important topic, the money supply. So when you come to a new topic, you need to get an idea of what the basic definition of that term is. So what is money supply. Money supply, you should clearly understand it. Money supply is the volume of money held by the households and firms for transactions and settlement of debts. Look at the key terms. It's the volume of money held by households and firms. Households and firms. So that means individuals or companies. And it does not include government. It does not include other banks. So the money supply contains volume of money held by households and firms for transactions and settlement of debts. So that is money supply. So whenever the term money supply comes into your mind, you need to know it's the volume of money held by households and firms. So that means individuals, not by banks or government. It's the volume of money held by firms and households. So how can you measure money supply? Money supply can be measured using monetary aggregates. We have monetary aggregates. So monetary aggregate is a tool that is used to measure money supply, and we have different classifications for this monetary aggregate, and we will start with M0, M1, M2, M3 and M4. M0, M1, M2, M3 and M4 are the names that are used to classify different types of money supply. So M0 is known as reserve money or high powered money or monetary base. So as the name suggests, we will start with M0. It is the high powered money or the reserve money or the base money. So this is the basis or the foundation of credit creation in an economy. The credit, more credit will be created from this monetary base. So this is the foundation. The foundation money is this M0, which is the reserve money or high powered money or monetary base. From this base, we will create more money in the economy. Okay. So it is the base of expansion of bank deposits and creation of money supply. So from this monetary base, banks will create more and more money. And what all are included in this reserve money? Take a look. M0 includes M0, which is high powered money or reserve money or monetary base, includes currency in circulation plus banks deposits with RBI and other deposits with RBI. So basically it's a reserve, or it is, this shows the balance sheet of RBI, right? Look, currency in circulation, those are the liabilities of RBI. Currency in circulation is a liability of the RBI. So on the liability part of the RBI, we have currency in circulation and banks deposits with RBI. That is another liability of RBI. Deposits are also liabilities of the RBI and other deposits with RBI. So these are all the liabilities of the RBI. So M0 can be compiled from the balance sheet of Reserve Bank of India. Okay, it can be compiled from the balance sheet of the RBI. So once again, take a look at it. M0 means currency in circulation plus banks deposits with the RBI plus other deposits, usually government and other financial institutions deposits with the RBI. So this is the money or the base money in an economy. This money is used by banks to create more and more money in the economy, and we will see how the money is created. So before that, we need to study the other remaining monetary aggregates also. Right now we have studied only M0 or the monetary base only. So we have M1 to M4 remaining. So this is the old aggregate, monetary aggregate. This was used by RBI to showcase the money supply in Indian economy. But we right now have a new monetary aggregate which we will discuss later. Okay. Now come to M1. We have already studied M0. Now come to M1. This is the currency with the public and demand deposit. This is the most liquid monetary aggregate, the most liquid thing. Look, currency with public, so it's the money in our pocket, it is always liquid, right? And the demand deposit, as I already told you, demand deposit, whenever you demand money, the bank should give you. So it is also very liquid. So M1 is the most liquid monetary aggregate, and also it is the narrowest one. So it is known as narrow money. So M1 is also known as narrow money, and it is the most liquid monetary aggregate out of these. This one is the base. This one M0 is the base. This is the M1 is the most liquid one. Okay, most liquid one. Now come to M2 and M3. M2 is M1 plus post office savings. So post office savings when added to M1 gives you M2. So compare the liquidity of M1 and M2. So when you compare the liquidity of M1 and M2, this post office savings is not as liquid as this M1. Okay, so that's why I told you M1 is the most liquid one. So when on comparing all these, the most liquid one is M1, because the two components, currency and demand deposit, are always heavily liquid. You can easily get the money, you can easily convert it. So that is what liquidity means. You can easily transact it. Okay. Then come to M3. M3 is broad money. M3 is broad money. Why? Look at the components. It consists of M1 plus net time deposits with banks. It consists of M1. So it consists of currency and demand deposit plus net time deposit with banks. So it is expanding, right? M1 consists of only currency and demand deposits. So when it comes to M3, it consists of net time deposit. So it from narrow, it is getting enlarged. So that is why M3 is known as broad money. Okay. So why it is given as net time deposit? Net time deposit means it consists of deposits of public only. It consists of deposits of public or the people, the households and firms only, and not interbank deposits. So in M3, the net time deposit, the word net is given because it consists of only the deposits of public and not interbank deposits are not considered in M3. Okay. Now come to M4. M4 is M3 plus all deposits with post office savings bank except national savings certificate. So M4 is M3 plus all deposits with post office savings account except the national savings certificate. I hope you got a good idea about what all these old monetary aggregates are. So now, after the recommendation of the Y.V. Reddy working group in 1998, Y.V. Reddy working group in 1998, Reserve Bank changed the monetary aggregates. It went from the old system to new system with few minor changes. And they have not changed the components or the definitions of M0 and M1. So when you compare the old monetary aggregates and the new monetary aggregates, the definitions of M0 and M1 from old and new remains unchanged. Okay, take a look at it. We have added N in front of all these monetary aggregates to denote it is new. See, NM0, NM1, NM2, NM3 stands for new M1, new M2, new M3. So that's the change in notations. Okay. So NM1 is basically currency with the public plus demand deposit with banking system plus other deposits with the RBI. There is no much change in that. It's basically, it reflects the non-interest bearing liabilities of the banking sector. Look at this, non-interest bearing liabilities. See, currency with the public, it is non-interest bearing, right? Demand deposit with the banking system or demand deposit of public with the banking system. It is also non-interest bearing or very feeble interest is there, right? See, you may be getting a very small interest rate for your demand deposit account. So it cannot be considered an interest when you compare it with the interest of recurrent deposit or with the interest of fixed deposit. The interest that you get in demand deposit account or savings bank account or current account is very low. So it can be considered a non-interest bearing liability of the bank. I already told you deposits are always liabilities of banks and currency is the liability of the Reserve Bank of India. So NM1 or M1, the old monetary aggregate M1 and the new monetary aggregate NM1 are same, and that shows the non-interest bearing monetary liabilities of the banking sector in India. Okay, so there is no change in the definition of M0 and M1 in old and new system, but in the new system they have introduced NM2. NM2 is the first difference that you can note from the old system of monetary aggregates and the new system. NM2 consists of M1 plus short-term time deposits of residents. So in our old M2, it consists of M1 plus post office savings. So right now in the new system, they have totally eliminated the post office system from the monetary aggregates. In the earlier one, we have post office savings in M2 and M4. So in the new system, they have eliminated entire components of post office because those are not actually, or those cannot be considered a huge, or they do not make a huge impact in the money supply. That's why they have removed it, and they have added short time deposits of short-term time deposits of residents. Short-term deposit means deposits that have a maturity period of up to 1 year. So NM2 consists of M1 plus short-term time deposits of residents. So this is one of the major change when you compare the old and the new system. The old system does not mention anything about the residents or non-residents, but when it comes to the new system, it specifically mentioned the short-term time deposits of residents. So residency is one of the major change that you can note in new and old monetary aggregates. And NM3, in M3 we have M1 plus net time deposits. Okay, see, when it comes to NM3 we have M2 plus, or this NM2 plus long-term time deposits of residents. See, look at the difference. In NM1 we have short-term time deposits of the residents, and when it comes to NM3 we have NM2 plus long-term time deposits of residents and call or term funding from the financial institutions. Call or term funding from the financial institution means the ways through which they are getting money. These are one of the ways through which the financial institutions get money for their business operations. So we will talk about that detail in the remaining chapter. So just go through the term. It's the call or term funding from financial institutions. These are the ways in which these financial institutions, especially banks, borrow money in order to carry out their operations. Okay, so there is a drastic change in NM2 and NM3 when you compare it with the old monetary aggregates. So here the narrow broad aspect remains the same. NM1 is the narrow one and NM3 is the broad one. Okay, so I hope you got a good idea about the old and new monetary aggregates. So when it comes to the new monetary aggregates, the working group has specially or separately mentioned the liquidity aggregates also. In the old monetary aggregate, there was no separation between money supply and liquidity. But when it comes to the new system, or the after the recommendation of the YV Reddy working group in 1998, they have separated the monetary aggregates and liquidity aggregates. So the new liquidity aggregates are termed as L1, L2 and L3. So here comes the post office component. L1 is NM3 plus all deposits with the post office savings bank excluding national savings certificate. So L1 is NM3, the thing that we have just mentioned. NM2 plus long-term time deposits of residents plus call or term funding of financial institutions. That is NM3. NM3 plus all deposits with post office savings bank except national savings certificate. And L2 is L1 plus term deposits with term lending institutions and refinancing institutions plus term borrowing by financial institutions plus certificates of deposits issued by financial institutions. And L3 is L2 plus public deposits of non-banking financial companies. See, this is not very important right now because this thing is more or less connected with core banking system. Okay, but the monetary aggregates are not like that. See, for a revenue service officer or for something who is into these financial departments, when you become civil service officer, you need to know this part. The liquidity is more or less it should be considered by the persons who are there in the banking system. Still, UPSC can ask question. That is why I have included it in the class. Okay, so just go through the terms. See now, how the banks create money. This is interesting. Okay, how the banks create money. Why should we know that? Why should an aspirant, a civil service aspirant, know how banks create money? Because that is essential to know the few terms that we are going to study right now. So first of all, take a look at this. I have made a chart here. Deposit in bank, required reserve and loans made by the bank. Suppose there is only one bank in an economy. It's for an easy example. Suppose there is only one bank in this economy. And so everyone who deposits money will be depositing that in the same bank. Okay. Suppose a person X made a deposit, initial deposit of 100 rupees in this bank. Banks will not lend out their entire deposits to as loan. Okay. So they will keep a reserve. So they will keep a particular amount aside to meet some emergencies. So here in this case, I have kept aside 20%. So 20% is the required reserve. 20% of the deposit will be kept as reserve in this case. Suppose, that's an example. So out of the 100 rupees initial investment, only 80 will be given as loan to another person. 20% of it, 20 rupees will be kept aside as a reserve. So this is how usually banks work. They will keep a part of the deposit as a reserve to meet some emergency. Okay, so right now a loan of 80 rupees is made to another person Y. And suppose if that person deposit the entire amount again in the bank. So we have only one bank in this economy and Y takes a loan of 80 rupees and he deposits it in this bank. So right now the deposit will become 100 plus 80. Right, 100 plus 80 is the new deposit in the bank. And only 80 rupees came in as new deposit, right? 80 rupees came in as new deposit. So 20% of the 80 rupees, that is 36 rupees. So 20% of 80, that is 36 rupees is set aside as required reserve. So entire 36, no, already we have 20 reserve. So plus 16 rupees. So out of this 80 rupee that come in as new deposit, 16 additional 16 rupees is kept aside as reserve. So that makes 20 plus 16, 36 rupees as the reserve. So 36 means 20%. So 20% is the required reserve in this case, in this example. So we have kept aside 20% of 80 rupees, that is 36 rupees as reserve, and balance of that is 64 rupees. So we already have a reserve of 20 In order to make a reserve of 36, we should add 16 rupees from this 80 rupees. So this 60 is 80 minus 16. That is 64 rupees is there that can be loaned to another person is said. Right? It can be loaned to another person is said. So suppose Z deposit that entire amount to this one. So that will become 244 rupees. Right? The 64 from there will be deposited in this bank. So that makes the deposit 244 rupees. So now I need to keep aside 20% of 244 as reserve here. And the remaining amount can be kept aside for loan. So when this cycle repeats, we will reach a point where the deposit in bank becomes 500, and at that point the reserve will become 100 rupees. See, if we continue this calculation, at the end the deposit in the bank will become 500, the required reserve will become 100. So that means 400 rupees can be given as loan. See, look at this. From 100 rupees, see, this is how the banks work. This is how the banks give you loan. Okay. So from 100, an initial deposit of 100 rupee, right now the banks made a deposit of 500 rupees. Look at the accounting. Okay. From an initial deposit of 100, the initial deposit of 100 has grown up to 500 rupees. So that's a 5 times growth in the deposit, or the initial deposit grown 5 times, and the right now after this growth the bank can loan 400 rupees. So this is how the banks create money. From this 100 rupee, the bank has created 500 rupees. So that shows the money gets multiplied 5 times. The money gets multiplied 5 times, and that is our next term, money multiplier. Money multiplier is an important term. Now why? Because the question about money multiplier was asked 2 times in the previous 10 years. And luckily in 2019 and 2020 or 21, the same question was asked. It was an exact copy paste. The same question was asked in 2019 and the same question was asked in the 2020 or 2021 paper. So there was a repetition of question. We usually think that UPSC do not repeat question, but when it comes to economy, you can see a lot of question gets repeated without any change in the statements. Okay, so that is a blessing. So now we have come to the term money multiplier. Money multiplier. So that means how the money gets multiplied in the banking system. How an initial investment of, or how an initial deposit of 100 rupees become 500 rupees. So that is money multiplier. So money multiplier. It is the ratio of stock of money to stock of high powered money. Stock of money means M1 and stock of high powered money means M0. Okay, it is the ratio of M1 to M0. So money multiplier means how the money gets multiplied in the banking system, and it can be found out through this equation. Money multiplier is equal to ratio of stock of money, that is M1, to ratio of to the stock of high powered money, which is M0. Okay, stock of money. So let us go through some mathematical calculations. What is M1? M1 means currency plus demand deposit, right? Currency plus demand deposit. What is M0? M0 consists of currency in circulation plus deposits of banks with RBI plus other deposit with RBI. So that means currency plus reserve. I am taking the 2 deposits with RBI as reserve. So basically M1 is currency plus demand deposit and 0 is currency plus reserves. Okay. So look at this term, reserve. So what happens if reserve money gets increased? What happens to money multiplier if reserve is increased? This is how the UPSC asks questions. Okay. So simply going through this definition may not be necessary in certain cases. So that's why I told you, you need to get a good clarity on what topics you study. So first of all, what is money multiplier? This is the ratio of stock of money to stock of high powered money. So you know the definition. Then you can deduce from that. What is stock of money? M1. What is stock of high powered money? M0. And M0 contains reserve. So in the denominator we have reserve. So what happens if reserve is increased? The denominator gets increased. So in a fraction, what happens if denominator is increased? The value of the fraction or the ratio gets reduced, right? It's simple mathematics. So what happens if reserve is increased? It is in the denominator. So the entire ratio or the money multiplier gets reduced. So when the reserve is increased, money multiplier gets reduced. And also upon extra derivation, we will come to this equation. Money multiplier is equal to 1 by cash reserve ratio. Money multiplier is equal to 1 by cash reserve ratio. Let me go through the previous example. In the previous example, the reserve was 20%, right? So I'll write the values from the previous example. There we have got money multiplier as 5, right? Money multiplier was 5 because an initial deposit of 100 became 500 at the end of the calculation. So that means a 5 times growth in the deposit. So money multiplier is 5. Reserve was 20%, right? So now put these values into this equation. Money multiplier will be 1 by CRR or 1 by cash reserve ratio. 1 by 20%. 1 by 20%. 20% means 20 by 100. That is equal to 100 by 20. That is equal to 5. Got it? From our accounting, we have got the answer money multiplier as 5. And upon substituting the cash reserve ratio as 20% in this equation, it is also giving the value money multiplier is equal to 5. So money multiplier is equal to ratio of stock of money to ratio of stock of high powered money, or it is 1 by cash reserve ratio. So whenever the reserve increases, money multiplier gets reduced. That is the thing that you need to keep in your mind. Okay. So we have come to the end of our session. So this is how you should study economics or Indian economy. So now you know what money is, what are the different type of money, how the banks create money, what are the different types of account, what money supply is, and what money multiplier is. Okay. So go through the topic clearly or get a clarity on the topics that we have just studied. Try to keep this in your mind, revise. And if you get a clear idea about all these things, you can go and attempt the previous year questions from these topics. Then I can assure you that if you know the basic definitions clearly, if you know the definition of money supply, if you know the definition of money multiplier, if you know the definition of fiat money, you can easily crack all the questions. 100% mark, I can assure you. You can easily crack without any delay, without even spending 30 seconds. You can easily answer all the questions from these topics in the previous UPSC prelims. Hope you all got a good idea about this topic. See you in the next session.